Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital.
I'm Chad Schiller, founder of Focus Capital.
Today, we're looking at two different ways investors can participate in real estate deals: equity investing and debt investing. Both can play a role in a portfolio, but they behave very differently. So part of our core discussion is kind of getting a wider lens on what is equity investing in real estate, and then what is debt investing and how does it differ. So let's start with equity investing, which is what most of our product offerings are. What is the difference between equity investing and debt investing? And let's stick with the equity investing side, and then we'll move into the debt investing side. So ownership in the property, participates in upside, and typically receives cash flow in the forms of distributions, and then also gets to participate in appreciation. You want to double tap into any of this?
Yeah, I would say also equity has a little higher risk than debt investing. But yeah, you covered the bullet points there on equity. I think the big thing for people, the equity piece, is they get the upside.
Yeah.
People that do that, they want to have the cash flow, but also have the potential for the upside long term. They're actual owners in that project, or owners in the entity that owns that project. And then debt investing is going to be, well, you're just going to invest in a debt instrument. You'll be loaning money to a property, to a person, and the only income you receive is the interest payments from that loan. That's it. There's no upside there. There's also no tax benefits really on that piece. That's a big one for some people, is they want the tax benefits, the tax play, the depreciation. That is simply only with equity investments, but with debt investments, again, a lot lower risk. Usually you come first place or second place in the property, something were to go wrong. So you've got more collateral, more tangible piece to go after. But again, your income is limited to just the interest payments.
Yeah, and I think that you brought up two very important points. Let's talk first about risk. You have a higher risk with equity investing, but that doesn't mean that debt investing is no risk. It's just lower risk. There's risk in any type of investment, real estate or otherwise. But like you were saying, it is collateralized. There's, a prom note, there's some tangible thing that you can kind of collect on, but there is risk. And we've talked about in previous episodes, you get compensated for your risk. It's not just compensation for a physical, tangible asset. You're also getting compensated for the risk that you're taking for the capital that you're putting out. You should be. And that's why different investment strategies, like for us, development usually has, and hopefully has, and always has, at least within our walls, a higher return than a core plus deal. But that also means that, investors aren't getting their distributions right away because there's no cash flow, or little to no cash flow because there's no tenants, because we're still developing that property.
No income.
And then with the debt side of things, there's still risk there. And that's why it's an investment, and it's not just, a high yield savings account. The second thing that I wanted to talk about is the tax benefits. There's no tax benefits in the debt lending, but there are a ton of tax benefits on the other side. And that's why most people, when they get into investing, they stay on the real estate side of things, because not just from an equity piece, but also this industry specifically has so many more tax advantages than even other investing. And so we're actually going to have a webinar on this later with a tax professional, and we'll link that down, the recording to it below, because it's happening this week before this episode airs. But I think that that's something really important for people to consider outside of returns, is what is your main investment strategy overall outside of this space? And is it capital preservation? Is it, I'm just wanting to build wealth? I'm just wanting to replace income? Or are you looking, hey, these, monthly or quarterly distributions, they're great, but they're not really what I'm looking for. I'm looking for capital preservation
Or tax play.
And tax play. And that's how you started this company, is the tax play side of things. You were making more than enough in your previous role. It was more the tax game. And so if that is your number one priority, you kind of already have your decision there between which investment model you should follow. How do these two positions sit in a capital stack? Let's talk about how debt gets paid, what order it gets, does debt get paid first? Does equity get paid first? And then how equity absorbs more risk, but also captures more upside.
Yeah, I think it's pretty simple. Like usually the very top of the capital stack, getting paid first, is a senior debt. Well, it could be second if there's other layers, would be a mezzanine debt or a secondary loan, a subordinate loan. And then bottom would be common equity.
And then what would senior debt, like, what does that mean to someone who
A
isn't?
bank loan, the original lender who made the loan on the property, the primary lender.
Hmm. And then the secondary would be like if there was an individual or someone that had, loaned for, are we talking bridge loans? Are we talking the life of the asset or?
I mean, it could be a line of credit. It could be anything that's not got first place lien on the property, really. So it could be a mezzanine debt. It could be a preferred equity shop. They could be other debt instruments from somebody that's got just a personal loan to somebody, a bridge loan on the property. That would come behind that primary lender.
Perfect. And then we talk about how equity absorbs more risk. What do you think the trade-off is from maybe even just a back of the napkin, like when it comes to no risk versus some risk, and what that upside could really pay out? Could you give us a just round number example of what that would look like?
Yeah. I mean, I think for equity investments, like we're going to target a 2x multiple over a 5-year period of time, for example, right? That's a 20% per year average. With the hopes to do better than that. That's the goal, is to outperform that every single time. And so there's many times where equity investments could do as well as 40%. It could be 80%. It could be very, very high, right? If it does very, very well. There's a lot of factors at play there. And if you're an equity investor, you're along for the ride, whether it does really good or not so good. Mm-hmm. So that's kind of why you're usually paid more through returns as an equity investor. With a debt investor, as a debt investor, you don't have the upside. You don't have the potential. If the deal does better, you still have your agreed upon rate of return for your interest rate in your loan. That's fixed. It's capped. There's nothing in there that says if we double the property's value here, you get paid extra, Mr. Lender. This doesn't happen like that.
Yeah, and to give a really real number example of that is usually you've talked about anywhere from 20 to 40 to 80% on the equity side, but typically it's capped. A higher number would be 10% is the return for the debt. And
yeah.
So giving that real juxtaposition of like 10% is already on the higher end on the debt side, and it really doesn't really get much higher than that, where the lower end of the scale that you gave for equity is double that. And maybe it's like, hey, if that's the lower end and I'm evaluating my risk and the time value of money and putting it into that's something that you can compare of like, hey, it's not worth twice the return because I'm taking on more than twice the risk. But when you get into those 40s, 50s, 60s and plus, then you can see I might be taking on twice the risk, but I'm getting more than twice the return. So your risk for percentage of return is technically lower when spread out on the equity side.
And again, that just goes back to like, what's your risk tolerance at your current age or situation? So these are both dependent upon your own situation. They may not be a fit for everyone. Mm-hmm. And some people may want to do all equity investments. They're young. They have a lot of runway here. They can go broke 5 times they had to. But some guys are maybe at the end of their lifespan, or they think they are. They may say, well, I don't have 5 years to invest in your deal, and I just want to do a debt play here and just earn 10% and be safe.
Yeah, I think that also timeline, and then also what type of returns you're looking at and what you're going to use those returns for. So, for example, it might not be someone who is 80 plus years old and only has a couple more years left from a hold period of time. It might be someone who's like, I just want to replace my income. That's my strategy. I don't care kind of about building long-term wealth. I have enough wealth, but I know that I'm going to become semi-retired or retired within the next X amount of years, which usually correlates to a certain age, but doesn't have to. And it's just like, I would like to receive not a guaranteed, but a relatively comfortable, monthly check or quarterly check that I can kind of count on from that perspective, where distributions on an equity side, we talked about this in a last episode, could be paid out or could be reserved for cash reserves on the property. And you really have to wait till the end of the hold period to get your main tranche of capital back. And so if your main goal is not tax advantages, is not, building long-term wealth or equity, you're just wanting kind of to replace your current income, then yeah, the debt instrument is a lot better play for you. So,
well, there's some people that we even have that want to do both. Mm-hmm. Because they may be like, well, we have this much money in your equity investment so far. We have more money to go deploy somewhere else. We like you guys as an operator, but we don't want to put any more like right now into these equity investments. We're going to put some into these debt investments as a sidecar, right? As a buffer to help diversify.
Yeah.
So that's an option too.
And the hope is for a lot of these passive investors to get to the point that they have so many passive investments in the fire that they're still getting distributions. And so if you were to invest in something that doesn't give distributions for the first 12 months, you're still fine because there's other things that are already distributing on. And then by the time that one rolls around, maybe you have another new investment that you're building in money because you've exited one of your other properties and then 1031 that into the next one. And so that's the hope for most of our passive investors, is that they do either have a mixture of the benefits where they're earning that monthly or quarterly income from distributions, but then also can create that buffer from a debt instrument in the interim if they need to. So kind of summarizing what we just talked about from risk and return: debt, lower risk, not zero, but also lower potential return with that cap.
Yeah.
Equity, higher risk, doesn't mean that it's high risk, it's just higher when juxtaposed to debt, and then higher potential return because it's uncapped. So not just higher potential return on the low side, but even higher from it could grow, especially if you choose the right operator. We tapped into this a little bit. Is there anything else that you wanted to add on who does each strategy tend to work best for? We talked about those customer profiles a little bit already, but what are kind of the main 3 bullets that you would say to pay attention to when you're introspectively evaluating deals for a debt investor?
Yeah, I would say, okay, what's your risk tolerance? Are you really risk averse right now? You're older in life and you don't want to rely on large equity appreciation to fund your net worth goals. That'd be one. 2 is like, okay, do you have an income goal you're trying to derive from these passive investments? That's probably the biggest one I see and some people as well that they've got money in a money market account somewhere, maybe earning 3-4%, and it's just sitting there for a couple of years. And for them, it may be perfect to put that into a debt fund, for example, to where it may earn 10+% over the next year. If they're already planning to hold it in the money market anyways, there's not a ton of difference there. There's more risk, but not a ton of difference there. They could get double the return on their money. So that's what I would see would be the most typical people to do the debt play, or also the people that want to do both things with an operator or a sponsor that has both instruments, debt and equity.
Yeah, and we have both instruments. Most of our product offerings are the equity piece. We raise per property. We don't raise in a fund, but we do have a debt income fund that we've started raising for this year out of the demand for our current portfolio of investors. But it's my job as the head of investor relations here is to not push one product over the other. Is really understand what is your strategy. And guess what? Our property raises are not the right product for some of our investors, and vice versa. Yeah. Our focused capital income fund is not the right instrument for other investors. And so understanding that for equity investors, their main, at least for our investor network, their main priorities are, the tax play and long-term wealth. Yeah. And we talked about real estate is not an impatient game. It's a patient man's game. It's a patient investor's game. And if I have certain investors that are not patient, they're looking for that return relatively quickly, a relatively, not guaranteed, but safe return, then yeah, the debt investing, the focused capital income fund investing is definitely the way to go. And they're just never going to be an equity investor because of where they're at in life and where their motivation is. And so understanding that as an operator perspective is that, having a different type of investor and understanding that at the front end helps build relationships and trust going forward.
Yeah, you brought up a good point, actually, because I thought about all of our equity investors. When you mentioned that thing about, most equity investors are looking for the tax play, the long-term appreciation, long-term wealth building, right? And that is true for most people. But then I thought about, well, there's some investors that are even more concerned about the cash flow distributions and the actual long-term growth. And it's just funny how you're going to have both those people in the equity group, but say, well, by averages, most of those equity investors, they are focused on the long-term play.
So I think it's also important, we talked about the benefits and the risks of both of them, but neither structure is inherently better. There's not hey, this is a better investment than this. But they just simply serve different roles within a total investment and strategy. And you said this multiple times during this episode, is there are a ton of people that do both and to fill in certain gaps because their priorities overlap between the two instruments. So to close, understanding the difference between equity and debt helps investors choose not just who to invest with, but what to invest in. And then they also help to choose opportunities that align with their risk tolerance, their timeline or time horizon, and their financial goals overall. Is there anything else that you would want to add on this subject?
No, we covered it, man. That was good. A lot of stuff there. Equity, debt, who it's good for, who's not good for. Yeah.
And the biggest thing is also, once you know what type of instrument you want to invest in, is like make sure that you have an operator that's going to help you reach those goals and the reason why you chose that instrument in the first place.
The important thing though is like you have to know what your goals are, and talk to somebody who really will find what's the best fit for you. Because I'm glad on your calls you're discussing their goals and making sure we find the right fit for them, because it's not one size fits all here. Like not everyone's best for equity investment or for debt investment.
And another important note for this episode in particular is like, if you're not sure about your goals, find an operator, find an IR person, or someone of the capital formation. Yeah, myself, you guys are welcome to reach out to me, but someone who knows what questions to ask you to kind of get to that end point where you're like, I know kind of what I want, but I don't know the terminology. I don't know where that puts me in. I mean, you see these kinds of things of like online quizzes all the time, like which character are you from this? And that's kind of basically what I do on a lot of my investor strategy calls. I'm like, let's talk about what's important to you. Not even about our properties, not even about our instruments. Let's talk about what's important to you as the investor. What are your goals? Let me ask a couple of probing questions to kind of get there. And then based off of your answers there, trust me when I am able to say, this is the product that is most aligned with your current goals.
Yeah.
And then if you kind of hear that and you're like, that's actually not what I wanted, I actually do want the long-term equity play, I actually do want these things, then it's a good way, that's why we call them discovery calls, to discover what your actual financial long-term goals is with investing.
Yeah, I love it, man.
Perfect.
Episode.
All right, see you next
week.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.